welcome to Season 3, Episode 17 of Unscripted Equity Curiosity, a Hedgeye podcast. My name is Ami Joseph, the Sector Head for Technology at Hedgeye. With me today is Joseph Batesplit, the Director of Technology at Hedgeye. We are without Andrew and Felix, who may have a chance to hop on later in the podcast, but I think we're going to be without them today. However, we do have a special guest, Howard Penney, the Sector Head for Restaurants, and a very important category of consumers, well, consumer staples, which he co-leads with Biolsi, who was on here talking about beer wars this summer. And we had Howard once on the podcast a year ago in July of 2022, and the episode was called Summer Smoke, and we talked mainly about cannabis, and I highly recommend going back and listening to that when you have a chance. It was one of our best episodes, one of our most popular episodes that we have ever had, talking about the trends in cannabis, the trends with legalization, the trends with monetization and development, and also the headwinds to equity prices and the difficulties with this new sector. But today we have a different mission with Howard, not cannabis. Well, we could talk about cannabis as part of it, but Howard, one of the things we're trying to do right now with our parts of our team here at Hedgeye is to take a big step back and to say, all right, let's say I'm a new investor in your space. Let's say institutional, right? Institutional or just, kind of RA, doing this at home or doing this with an RIA, doing this with retirement money for people. And I need to get started on your sector. I'm excited about it. I want to learn more. How do I get started? Give us who are the top 5 most important companies in the space? What are the top 3 most important trends? And when you're analyzing any single company, what are the most important signal metrics that you have to be aware of that are either going to make it a big long or a big short? Kind of you really pay attention to, sort of one of the first things you pay attention to. You're laughing. I don't know. I must have said something funny.
How do I answer that question?
You take it in whatever direction you want.
Boil it down into one thing.
You take it. Hey, man, we got time. You take it however you want. You take a question however you want.
Well, first on season 3 is very impressive. That you're onto season 3. I just want to say congratulations.
Thank you.
And then thank you for having me on again. We can definitely talk about cannabis just because it's timely again. This key signal is bullish on cannabis. Anyway, but so the restaurants in the interesting group to follow, right? Because a lot of people, first to answer your question, McDonald's, Starbucks, the two biggest, $100 billion companies out there, they definitely drive what's happening in the industry. And, I used to say over the years, McDonald's is the most, if you don't follow McDonald's, you don't follow the restaurant industry, right? Because they drive so much of what's happening in the industry. But now, it's McDonald's, Starbucks, Yum Brands, which owns pizza, KFC, and Taco Bell. But those are, the 3 big. I mean, Wendy's is out there, but it's kind of a small player in the space. But kind of Yum, Starbucks, and McDonald's are the big 3 because they dominate. One, the market cap of the industry, but 2, their brands are pretty much where people go. McDonald's, obviously, everybody knows about McDonald's. So those are the big ones, but what happens a lot of time when I have conversations with institutional investors is a lot of people put their personal preferences into the space. It used to be, I don't like plain boiled burgers, right? So I'm not going to buy, Burger King or QSR or restaurant brands. Or I don't eat at McDonald's. I haven't eaten at McDonald's in 5 years. I won't own the stock, right? Well, that's fine, but McDonald's is a $150 billion company for a reason, and it's got 30,000 stores for a reason, right? Because a lot of people eat McDonald's, and so the first thing you got to do is just forget about any personal preferences you have against fast food or Outback Steakhouse or any one of these trends, because you won't make money in the industry. And my strategy has always been to, go where there's controversy, frankly, because I'm not a momentum person, which has cost me some money over the years. But, when there's controversy in a restaurant name, it's usually down and out, right? And I'll go back to, probably my most successful call. I just use this as a great example because I've done it. When there's two of them actually. When we first started Hedgeye back in 2008, 2009, Starbucks was a $9 stock.
Oh,
right. And McDonald's was just coming out with, it had just put espresso machines in their stores. And, McDonald's was advertising on billboards, $4 coffee is done, saying, that they're going to put Starbucks out of business, right? And so the stock was beaten down. They had grown too fast. They're having to close stores, slow their growth down. And people were like, the Starbucks story is over. I mean, it's just beginning, right? And so there was all this controversy in Starbucks. And Keith had it on, he had it on from like $9 to 50 or 60. Like it was a 10 bagger for his, what do you call it? The signals, not the signals.
RTA.
The real-time alerts.
Yeah.
I mean, the most successful real-time alert in Hedgeye history. And I can make this, I can create a story like this for just about every restaurant company. Chipotle, right? Chipotle was run into the ground. It was a $250 stock 6 years ago, right? The CEO was fired. People, they had just poisoned, hundreds of people with because they didn't have proper guardrails around their supply chain, right? So they poisoned people on the East Coast, on the West Coast, and in the Midwest, and the stock goes from, $500 to $250, and CEOs fired, and they're like, the consumer's never going to go to Chipotle again. Well, bullshit. Of course they're going to go to Chipotle, right? So now it's it was a $250 stock, and it got to $2,000. So these are like the scenarios that you really look for in the restaurant industry, frankly, as to like how you make the most money. Where is there controversy? And you could say it on the short side too, but the short side's a little harder. And, I had a great success with Chipotle on the long side, but I've been for, 18 months now trying to call the top in Chipotle, right? Because it's gone from 250 to, 2,100 or something like that, because there's a few cracks in the armor of Chipotle. So, I don't know if that answers your question, but that's kind of the way that I, try to find my best ideas, other than, the weekly, the thing that we have been hamstring over the years, was the credit card data, right? Credit card data for years and years and years has been an important component of the buy side's, analysis of how stock companies are doing, right? And Chipotle has a really high correlation to the credit card data because it's company owned, whereas McDonald's not so much, right? Because it's more of a cash business than Chipotle. If you're a digital business, you're going to have more of a credit card component to it, as opposed to a McDonald's, which has a pretty significant cash component to it. So you can't really accurately check. But now that's sort of shifting in the sense, because there's now a lot more AI, right? And as we talked about before, we can now track, cell phones. We and a lot of other people can track cell phones going in and out of these restaurants. And so it's gotten, that credit card data, which was so dominant to driving stock prices. It's not that it's not dominant, but it's slowed down its appeal, I think, because there are now other ways of looking at trends for the industry. But the most important, factor across any restaurant company is comps, right? Is same store sales, right? Because there's, not to boil it down and make it too easy, but you've got top line, and then you got what we call the middle of the P&L, right? Food, labor, other costs. And so if you can get the top line right, if 40% of your costs are fixed because of labor, right, then you can usually get directionally where margins are going. And then depending on what your menu looks like, if it's chicken or beef or avocados in the case of Chipotle, you can get the food cost, but food cost is variable, right? So it's an important element, but so comps has always been the most important metric that drives stock prices and ultimately valuation. There's also a pretty good correlation. If you're going to do a 10% comp, you're going to have the highest multiple in the group. If you're going to do a -10, you're going to have the lowest multiple in the group. So those inflection points of seeing the acceleration in comps and the deceleration in comps is important because it really drives the multiple. So I don't know if I'm going off on a tangent now, but I think that pretty much summarizes how I view the industry and what are kind of the most important elements.
Awesome. Okay, so you opened up like several questions, and I've got a bunch on the stuff you were just talking about, including AI and inflation and pricing and stuff like that. But I want to go to one level back when you were talking about the down and out approach versus the momentum approach. So my guess is the momentum approach would be like some restaurant chain that only has 500 stores today, but they could get to 2,500 or something like that. Is there? I'm guessing, right? Like, is that right? Is that the right?
The momentum is more of the top. Yeah, yes, that's true. Right. There's two components to the momentum. There's the store growth, right? So, again, we'll just come back to Chipotle. Chipotle's got 2,000 stores, could go to 7,000, right? McDonald's has got 35,000 stores and, is probably, shrinking or just flatlining, right? So the McDonald's momentum is top line, right? Comp momentum. The Chipotle momentum, or Cava, which just came public, right, is they've got that huge store growth and they got the comp, right? They got that, same store sales number. So, but when I think of momentum, I'm generally thinking of comps. I'm thinking of same store sales.
Got it.
And that's driven by, the last, call it 18 months, it's been driven by pricing for the most part, as everybody was really aggressive raising prices into the inflation that we were seeing, and not really cognizant of traffic and what's happening to traffic. And now we're starting to see, traffic really slow across the industry. But so momentum, when I talk about momentum, when I think about momentum, it really is comp or same store sales.
Got it. Okay, so then if I were to ask about the store growth types, so you said Chipotle could go to 7,000 stores. Cava, what's the metric on Cava? Where are they now versus where you think they could go? Like
150, and they could get to 2,000.
Wow. And then
sorry, 250. They're at 250.
250. Are there any other brands that, when you think about, who are kind of in that, like, they have scale, they have momentum, they really have the right formula, and they could become very big?
I mean, there's a few, but I'm skeptical of them getting there, right? So you have Portillo. There's a couple of companies that have come public recently. Portillo's, right, which is an old hot dog. Yeah, Portillo's hot dogs. It's called. It's a Chicago-based company, and they've got 80 stores, and they could go to 200 or something, or 300 or 400. I mean, it's kind of, if you're one of these restaurant companies and you say let's just use Portillo's. They have 80 stores today. They say they could have 350. Once, 3 years goes by and they've opened up, another 50 stores, right? And they're much closer to that 50% penetration from what they've said. They'll hire a consultant and go out and figure out how they might put more stores in a different geography. And so all of a sudden that $500 or $400 or 400 store limit goes to $750. So everybody sort of always raises the bar when you're thinking of these smaller chains. Like, Shake Shack, they think they could probably have 1,000. They've got, a couple hundred. So the store piece is not as relevant, frankly, because, unless you're McDonald's and Starbucks and you're really, you're in the 30,000 range. But there's also the component to how many stores you can have based on your average check too, right? So we'll use, Capital Grill, right? It's $100 average check, maybe 150 today, but $100 average check. You're only going to have 50 Capital Grills in the country, right? McDonald's has an average check of $7, and it's got 35,000 stores, right? So the potential, store potential is a big function of, how big your check is. Like same thing, Starbucks is in that, $6-7 average check range, and they're in that 30,000 range too. So, even though, a Portillo's or one of these other smaller chains, thinks they can have this huge number of stores, it's getting there is also harder today, just because Main and Main is pretty much taken up by a concept already.
So it gives me like some thoughts, because obviously you have to evaluate the brand and the model, right? Like you have to be able to go to a Portillo's, or at least tour a few of them, and make sure that you think that they have the right business model and they have figured out how to scale profitably, right? Like, for example, I'm thinking about somebody like H-E-B on the grocery side, who, if they came to the Northeast, they would put everybody out of business. They're an amazing model, but they don't want to go to the Northeast for whatever reason. So I'm just kind of like thinking about like because you will encounter brands who are like, 100 stores, who say they're going to go to 5,000 stores, and you're like, absolutely, they'll never get there.
So there's two ways to answer that question. Yes, it's important to eat the food, right? But if you go back to what I said,
you can't. But I wasn't even
right, because they're like, I really love Portillo's hot dogs,
right?
This is
nothing. It means nothing.
It doesn't mean anything,
right?
Because what you like is, or don't like, is Mike.
No, it's more about like consumer surveys, like consumers like.
Yeah, yes and no. So we'll just stick with Portillo's as an example, right? Because and this Shake Shack, this is a story we've told on Shake Shack for years. So Portillo's has 80 stores. They think they can have, 200, right? So they're now going to they've accelerated their store openings, right? Meaning, they think they can grow 10% a year in store growth, right? They're growing from Chicago, now they're into Dallas, Texas, right? And other, going to California. So that geographic expansion creates problems for the four-wall model in Chicago and Illinois is very strong, right? But as soon as you accelerate your unit growth, right, you're going to cannibalize existing stores, and that is a huge negative in the restaurant industry. And you're also creating inefficiencies, right? Because new stores take a while to ramp up profitability, right? You don't open up at peak profitability because you've got training costs. There's a whole element to making sure that, the first 3 months or the first 6 months goes really well so you don't piss off consumers, right? So that creates inefficiencies in the model, right? Because then you have a bigger portion of your store base, which has lower margins, right? And you're now cannibalizing your existing stores. So your comp's slow. So those are two huge negatives that restaurant investors don't want to see. So you don't want to own a Portillo's today, right? Because they're cannibalizing their comps. So the comp growth isn't going to be good, which gets back to that first thing I said. The thing that really matters in the restaurant space is comp growth. Well, if you're growing so fast, you're cannibalizing, or you don't care about comps, that's a negative. That's a red flag, right? And then the second one is, if you're growing so fast, a bigger portion of your store base is immature, creating margin pressure. That's a second red flag. Right. And then if you've got the geographic diversity, so you don't know how well, a new chain like Portillo's is going to do in a new market, right? Red flag number 3. So, that doesn't make Portillo's a great equity investment right now. It might be, and that has nothing to do with the taste of the hot dogs. Like Nick Balch, who works with me, loves Portillo's. He grew up on Portillo's. Like, every time he goes back to Chicago, he goes to Portillo's, but doesn't make a great stock.
Awesome. So basically, like, even if you get excited about a certain brand being able to go from 500 stores to 5,000, even though maybe point to point across like a 10-year horizon, maybe that would be a good stock because they're going to have that much larger of a base. In the medium term of 2 years, it could be a disaster.
Correct.
That's fascinating. Okay. Let's talk about the other side of that piece that we were just talking about, which is the down and outs. Like, who's like a down and out today? Can you give us an example of someone who's down and out?
So we made a call on Restaurant Brands, RBI, because the stock is not, it's not a great example of a down and out name, because the stock hasn't gotten crushed, right? But it's been mismanaged for years. So it was part of the 3G portfolio and the zero-based budgeting story, right? 3G blew up Anheuser-Busch, blew up Kraft Heinz, and blew up RBI, right? Because
I don't have the background on this. What is the background?
Basically, zero-based budgeting is, you come in and you slash non-essential G&A, right? And you effectively, in the restaurant industry, which I know the best, is you're taking away, in the case of Restaurant Brands, which is 90% franchise, you're taking away resources from your franchisees, and or you're eliminating non-essential marketing spending or R&D spending, right? You're literally cutting your budgets back to minimal amounts. Well, in the restaurant industry, that's a disaster. You cannot not invest in marketing or R&D, or more importantly, your franchisees, right? So they, QSR has Symbols QSR, Restaurant Brands, has underperformed McDonald's, Starbucks, Yum, all the big players over the last 10 years by hundreds of basis points, right? So in the end of last year, basically they fired the CEO, brought in a new one, and then brought in Patrick Doyle, who was probably one of the best CEOs in the industry running Domino's, and it was a 10-bagger when he was running Domino's, right? Because he knows how to run these franchise brands. So we said in a deck that we did, the end of last year, bringing Patrick Doyle in is going to change around Burger King, which is, the one brand that is, not been turned around recently. And there's a lot of upside for him in turning around or helping turn around Burger King, and helping to turn around Burger King includes making the franchisees more profitable, right? So this is now a story that will unfold over the next years. And guess what? He got a ton of stock, right? He's being paid in equity. So he's got a lot of skin in the game, right? So, but it's not a perfect example of a down and out name where the stock is beaten up. And I don't think I don't have, just because we've been through, kind of a bull market here, for a while in the restaurant names coming out of the pandemic, there isn't a great, I'm just looking at the list here. There's no name that I'm saying, this is the next Chipotle, or this is the next, McDonald's, or this is Starbucks at $9. I don't have one of those right now.
And, but I do see, I know, I hear you're saying that it hasn't been, that the stock hasn't been crushed, but they are flat across a 5-year horizon, basically. Although,
pull it up, Mr. McDonald. It's insane.
Well, even Domino's, it looks like, is flattish over that time frame. Now that I'm looking at that, and McDonald's,
So Domino's is a little different because the last, the rise of DoorDash and Uber Eats and has created a level of competition for delivery for Domino's that they have never seen in 40 or 50 years, right? Domino's is delivering pizzas for 50 years. In the last 5, it's been much harder because there's now a new competitor that can deliver pizzas. Like, pizza is the number one delivered product on DoorDash. So, and it's helped the mom and pops, right? Because, mom and pop pizza has a new ability to sell more pizzas because they can go through Uber Eats and DoorDash. So that's been Domino's biggest problem, is for years and years and years, they didn't have a competitor for pizza delivery, and now they've got 2 huge ones. So, which is why they have now, come to grips with reality and have said, guess what? We need to go on those marketplaces. We've got to, they signed an agreement, 4 or 5 months ago now to go on the Uber Eats platform as a test, right? Because they had resisted going into these marketplaces to putting their stores and their pizza in these big, huge marketplaces, because why? We're Domino's. We don't need to. Well, they've gotten so big now that, it's almost time for them to do this. So, and they'll, by this time next year, you will see a press release from Domino's saying they're going to be on the DoorDash marketplace.
I wonder, I personally find Domino's so easier to order just straight, rather than, like, I find it easier than anything on DoorDash or Uber Eats, but that's just me.
Here's maybe a fun fact that you don't know, Ami, is that half of Domino's business is pickup.
Oh, interesting.
Yeah.
Yeah, it's so easy to order. It's just the easiest thing to order for delivery. I want to come back to something you mentioned in the last piece of your kind of like process, which is about, you said comps and momentum, and you said that recently there was a lot of big price movements. For example, like, in COVID, we had to shut down so many restaurants. All restaurants for a period were shut down, and then they started to reopen, but only some of them disappeared. A lot of restaurants disappeared and never came back. And then in 2021, across 21, there was like a huge price increase. Like, just even seeing it from my little corner of, taking kids to Cheesecake Factory everyone once a month. Like, dinner for 6 of us used to be under $100, and now it's easily over 100 and 125, 130 every single time. Since across 2021, we saw that change. And so you're saying now that price increase has aged out of earnings. So that catalyst has washed through, and now they actually need to grow with foot traffic. And so you're saying the foot traffic is slowing. Is that kind of like a broad statement for the industry?
Yeah. So yes, the answer is yes. But there's 2 components to it. It's not universal across every concept, right? So there are some concepts like Cabo, which has become very popular and much smaller, that is seeing positive traffic. Starbucks is seeing positive traffic. McDonald's, until recently, was seeing significant traffic. So there's, it's brand by brand, but casual dining as a group, right? So Applebee's, Outback Steakhouse, Chili's, they are seeing declines in traffic and have seen declines in traffic for basically the last 10 years. And as people go elsewhere. So the best way to think about it is family dining 20 years or 30 years ago, right? IHOP, Denny's, those were really popular, right? And then in the 80s and 90s came casual dining, right? So it was kind of a step up from family dining, right? But it was a broader menu, and they sort of became the high, the fad part of the restaurant industry back, in the 90s when Outback was growing units at 10% a year, and Applebee's was growing really fast, and Chili's. Now those concepts have been replaced with or not replaced, but the new service model within the industry has emerged, right? And that's the fast casual. So it's a little higher quality product than a McDonald's, right? But a little lower price point than a Chili's to a certain degree, right? So that has created like this avenue for these fast casual chains, Chipotle, Cava, Shake Shack, and the like to really grow their units. And it's a much lower cost from a restaurant labor standpoint. You don't need as much labor. You don't spend as much on labor. More importantly, you need fewer people to run the stores. So that has wreaked havoc in the industry, for the last couple of years. So I don't know where I was going with that.
Well, actually, let's stay with that for one more second, which is that a mega trend that you think continues, or do you already see the beginnings of that trend being tired and maybe potential for some other trend that will replace it coming?
Say that again.
Do you see the fast casual trend as a mega trend that is still just getting momentum and will continue for another decade, or is it already tired?
I don't know if it's just, it certainly has room to run, right? Because there's new concepts like Haba, right? And it's certainly in this environment where you have, higher labor costs, trying to, reduce that cost and implement, some element of technology that will allow you to reduce labor costs. But certainly, there's certainly more room to run from a labor standpoint or from a concept standpoint for the fast casual guys than any other segment of the industry. People aren't going to, Chili's and Outback anymore, right? They're trying to make a comeback, but they're, for the most part, they're being replaced by the new business models.
And there's no next thing that you can see already bubbling up, either that is an R&D for some of the big shops now, or anything or kind of like on the smaller trend where you're just seeing the beginning of some kind of tailwind.
I don't see any, not right now. I mean, yeah.
Okay. Got it. Joseph and Andrew, I don't know if you guys want to pop in with any questions. I'm going to ask another one right now about data sets, but if you guys want to prepare for the next up after this. So on data sets, you mentioned that credit card data is sort of like the standard for the industry, the buy side industry, the investment industry. So
standard for those who can afford it. It's really expensive.
Well, I'll say that Joseph and I, in our areas that overlap with credit card data, by the time people see the credit card data, it's usually last to know. You know what I'm saying? It's almost like it's like the day after earnings, making a bet on what earnings would be when the credit card data comes out.
If you pull up a chart right now of Wingstop,
okay,
right? Wingstop has been a little bit on a tear the last couple of weeks.
Okay.
Right? So and also McDonald's has been getting crushed, right? The stock has been getting crushed. So if you look at, I don't have access to the credit card data, but I have access to cell phone data, right? So cell phones going through these stores. You've seen an acceleration in weekly cell phones going through Wingstop. So they were decelerating, into, call it, mid-August. And then since August have seen this acceleration into the most recent week. And you can see it. I get questions, what's happening with Wingstop? Well, I'm going to guess that the credit card data is better because I'm seeing the traffic better because there's more cell phones going through it. And we made this call. McDonald's was the best idea long for us for a year and a half, right? And it had, call it 8 to 9% traffic growth for the better part of 2 years. And then just about 2 months ago, all of a sudden it went negative and it has been decelerating for almost 6 weeks in a row. And if you look back, McDonald's stock has gotten crushed over that time period. So the credit card data, the cell phone data, and the AI, if you will, definitely has an impact on these names. And if you look at a short-term move in some of these stocks, I will bet that before I can see the traffic data with the cell phones, right? I would have told you the credit card data is saying something positive or negative depending on.
Right. So it moves the stock in like real time because the large institutions get it the day of, and then they're putting positions in place. So wait, so I want to ask, so the data you're talking about, the AI data that you're talking about is basically like if I, me, Ami, walk into Applebee's, let's say, even if I don't even take my cell phone out of my pocket, the Wi-Fi of Applebee's knows that my phone number is in Applebee's, and all of that is aggregated, and I have a customer profile, and all of that is sort of shared out into some kind of like data warehouse data.
I am going to decline answering that question.
Okay.
Because I cannot.
Okay, fine.
I have been told a number of times how this works, but I will not be able to tell.
Okay, fair enough. Fair enough. But your data seems to be fairly unique. Is it unique to Hedgeye that you have this AI?
No, I mean, if anybody that wants to buy the data, you can buy it. I mean, Placer will be very happy to. I mean, it's not cheap, right? But they'll sell it to anybody that wants to buy it. But you also need to correlate that with other elements, right? We have models. We have the other data sets of the industry, the Knapp-Track data, which is casual dining, and then the broader black box data, industry data. So we can look at what's happening across, the broader segments of the industry first, right? Casual dining, full service, sit down dining, and then limited service, right? So you start with that piece, and then you create the funnel, and you understand what's working, what's not working. We've got 8 different segments of the industry that we've broken down to between steakhouses, breakfast, fast casual, coffee, and then once we kind of get a bigger picture view of the industry, narrow down the funnel to the subsectors, and then understanding what's driving the different companies within those subsectors.
And that when you produce all of that data, is that available to, I'm assuming that's available to your institutional subscribers. Is it also available to pro as well, or just institutional? Okay. So those listening, if you can afford it, highly recommend getting on Howard's institutional subscription, giving that a try, and get the data and see how this brand new data is influencing things. Because obviously from the example we just saw with McDonald's and Wingstop, it's going to have immediate swings. And even if you like something in the long term, you got to be aware of what's happening in the short term so that you can either trade around it or not do the obvious and puke because you're scared, or vice versa, or get too big in a position that is rolling over.
I would go back to March I just pulled up the chart because you can do this real time, right? If you have access to it. By brand. And we have 100 different brands in this file. So it's not publicly traded companies. It's some private companies too, which are important to understand what's going on. But I just did it by month, and I go back to March of February of 2022. McDonald's was running 8 to 9% traffic growth, right? Until August of this year. And now it was down 2% in August and down 4% in September.
Wow.
So now pull up the chart of McDonald's. Yeah. It works like this. It's the other. So there's some problems with this data, just to be completely upfront. It's cell phone traffic, right? Going through stores. But there's also other components to the comp, right? It doesn't mean McDonald's can have a down 4 comp because they may have raised prices 5%, right? Or they may be selling a higher mix item. So you have 3 components to your same store sales, right? You've got the traffic, the number of people that are going in, and then you've got what they're doing to their menu with their, promotions, driving people to buy a more expensive item or less expensive item, and then the absolute price increase. So it gives you a signal directionally of where the foot traffic is going and not a complete read on the comp. So just to be clear, but what we care about, especially here at Hedgeye, is the rate of change acceleration, deceleration, And this was back in August, a clear rate of change, deceleration for McDonald's. And its traffic is trending for, over 2 years.
That's brilliant. And also so strong of you to like react quickly and move with that, as opposed to like try to fight it with thesis and trying to offset and all that kind of stuff. It's something that it's possible. And I happen to do that a bunch, just like to get trapped even when the data is negative, to be like, wow, I really like it though in the long run and it'll be okay. And then like you're riding it for a while. So it happens. I know Joseph has a follow-up to all this. Joseph, why don't you jump in?
Hello, Joseph.
Hello, Howard. Thank you very much. This has been so fascinating. I just have one. It's occurred to me that you guys in your space have gotten a bunch of IPOs recently, and I think that's, at least before this last year, that seemed like a relatively rare occurrence in your space. Correct me if I'm wrong, but that's kind of how it seems. So I'm curious, like, what have you learned from this new cohort of companies that you've seen come through? Any new things, interesting things that you would call out?
So there's playing on the most important one that came public is Kava, right? And it's playing on a theme. It played on two important themes. One, Chipotle, because again, Chipotle is still doing really well. It has a service model like Chipotle, so you're basically going down the line and telling people you want this, this, and this, and they're making your bowl or your burrito. And it also has significant store growth. So it kind of plays into that theme. Whereas you won't have, it's the sexier part of the industry, frankly. And then the other one that came public recently for us was Instacart, which is, playing on the delivery theme, frankly, which is a little less sexy than DoorDash, which we don't like. But the two themes would be, sort of delivery, if you will, or getting food delivered to you, and then the fast casual space of the industry.
Got it. Glenn, do you guys have a bunch of more IPOs in the pipeline, or do you think that we've kind of seen the last of them for now?
There are rumored to be 3 companies, private companies, obviously, that want to come public. Yeah, there's definitely, the success of Kava has definitely woken up companies that, that might play in that space that want to come public. So there's actually a restaurant company that actually has an alcohol subscription to it that wants to come public. So yes, there could be more. Whether they get out, I don't know. We got this question. We do a show every Monday, the consumables show, Nick and Daniel and I, and we got that question actually on the show. Is the IPO on this past Monday? Is the IPO window closed? And I would have kind of mixed emotions about it. Maybe now, given the drawdown in the S&P here recently, it might be closed. But if you've got a strong concept like Kava, and you've got traffic, comps, unit growth, you can probably still get out the door. It might be a little harder today, but I think a company that's got a good business model that's profitable will certainly could get out the door. But that window is definitely closing if it's not already closed.
Got it. Cool. Okay, awesome. I'll turn over to Andrew if he has any other questions here.
Go ahead. Do you want to ask, or do you want me to jump in?
No, you can jump in. I was just going to ask about McDonald's, but you guys already hit on it. I was going to ask what's going on there, but I'll let you throw it back.
No one eating the French fries anymore.
Yeah, very funny. Actually, no, they're renovating the McDonald's near me, so that's all the traffic is. I can't go in 10 times a day, and that affects traffic.
Wait, Howard, when did they move to all kiosks? Because I went to McDonald's for like the first time in years, like a month or so ago, and I was like, wow, there's all kiosks in here. There's like no people to order. Like, when did they make that shift?
So that was a shift that probably in earnest started 4 years ago, but it's been a slow roll. Right. I mean, they do a couple hundred. They were doing, call it 300 or 400 stores a year, and there's 30 something thousand. So it's been a slow roll, but that's also another theme, Andrew, that's running through the industry because labor costs are so high, right? And you need to implement as much technology as possible to reduce labor costs. And it was difficult for McDonald's to begin that process because the not the unions, but I forget the group that the National Labor Relations Board, I think, the NLRB, right, which has been a big thorn in McDonald's side for years. And to the degree that McDonald's is implementing technology to reduce, to fire people, it was a delicate balance that they've been managing for the last couple of years. But if you look at Chipotle, actually has two huge initiatives today. One, they've got a guacamole maker to peel, not a guacamole maker, but to peel avocados. They literally are testing a machine to peel avocados, and they're also testing a line that basically reduces part of the labor costs for the people that are making your burrito bowl or something. So it's a big, and then Sweetgreens has an automated robot to making salads. So we got a long road for technology to replace labor, but it's slowly happening.
Cool. I guess maybe this would be my last one, and I know we're right up against the time, but and this has been fantastic, like a fantastic introduction to your space. I really appreciate the time today, Howard. My last sort of question is sort of taking on that last little bit that you were talking about automation and such and robotics. When you think about, and you can veer off of that trend, but when you think about take a big step back and like imagine where this industry is going to be in 5 to 7 years, and like let's say we regroup, 7 years from now. Are we going to still be talking about same-store sales and comps? Is that the main thing? It's always going to be the main thing. Do you think there's some overarching trend that's coming, some kind of new? Is there any major change you think that is really going? That's just in the very beginning, and like
it's all about people coming into your store,
be hungry Americans,
because that's
going to eat.
Yeah, but it's a sign of success, right? You get more people coming in year over year, and not less. I mean, it's almost that simple.
And the health food kick or anything dieting, those things don't matter basically, because the restaurants swim with those things, right? Like they change the menu, they added this, they take away that sugar, and they add this, and
there's every 5 or 6 years ago, you get these fads, right? Of people want salad bars, or they want plant-based. Like 4 years ago, it was where everybody was going to eat plant-based burgers. I mean, nobody wants a plant-based burger. I mean, so you get these trends every once in a while that you think might be disruptive. But the fact of the matter is, and we'll go back to the very beginning of how we started this call, right? McDonald's is a 35,000 store chain in $100+ billion market cap, and they do one thing for a reason: is because people want burgers, fries, and a Coke, or burger, fries, and a water. I mean, it's that's what people eat.
And then, okay, so since that one didn't go anywhere, maybe I'll ask one more question, which is Starbucks broken?
Temporarily.
And
so McDonald's had the same problem Starbucks had 10 years ago, right? So if you think about all of these boxes, it doesn't matter. Take Starbucks off the side, take Starbucks off the window sign, take McDonald's, take Wendy's, take Taco Bell. Time and motion within the four walls is critical. When you're as efficient as these boxes are, and they're built literally with no square footage to spare, right? If you want to continually add new products, right? So McDonald's years ago added an espresso machine, right? So when you go into a McDonald's, you order it, they turn around, they get your Coke, they turn around and get your burger, and you come back and you go, right? So if time and motion, as soon as that person had to take 3 extra steps to go get an espresso, it totally disrupted the McDonald's business model. And I'm simplifying this a little bit just because we're almost out of time. Starbucks has created all of these products, right? And so it's no longer, they've got a blender in there, they got the cold coffee, they got the cold brew, they've got, all these different products. So time and motion has created, or the increase in time and motion in a typical Starbucks store has made it really difficult for a barista to work and made the job miserable. So they've got to, if you look at what they've introduced recently, right, this was last November, they're introducing new technology to reduce that time and motion in order to increase the throughput. McDonald's had this problem years ago. They figured it out and they got past it, right? Starbucks is just right in the middle of that. And they haven't quite figured out how to improve that time and motion within the 4 walls to allow, the expanse of these products that they've created. So can it be fixed? Absolutely. Do I think they fixed it? No, I don't. I think there's still a lot more money that needs to be spent and time that needs to be spent. And you have a new CEO trying to do it who knows nothing about the business. Like, how does that work?
Yeah. I mean, from our little corner of the world, we used to see employees were like so proud to work at Starbucks because they had great programs and great, for the employees in healthcare and things like that and whatever, and flexible work. And now every employee you talk to is like miserable and whatever, et cetera. It seems like big change in the last few years.
Yeah. And just the fact that you've got 50 or 60 stores that are now unionized.
Interesting.
For Starbucks is also it's not going to go anywhere because the company is anti-union, but it says something about the, how satisfied or how content employees are at Starbucks.
And you, as the first and cornerstone member of the Hedgeye Union, will get. All right. Well, that was the last one, as I promised 2 questions ago. But Howard, again, thank you for joining us. For those listening, this has been
Andrew,
episode 17, and
it's a pleasure talking to you guys.
Thank you very much, Howard. Really appreciate it. Have a great weekend.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws as intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.